Have you seen any lenders shying away from new build projects now?
They're not shying away. It's all about they will only take on the right deal for them. And people need to be aware that it's not a market value you're doing, it's a residual value based on the GDV, working backwards, contingency, profit, all put into the calculations. And the day one land loan can be quite low, but that's so that the people that are doing it are putting a lot of cash into the deal.
So what's next for interest rates in 2025, and what do you need to factor in as an investor going forward? Today we're actually joined by Carl Griggs from CPC Finance. Welcome, Carl.
Hi, good morning.
Now, Carl, just give us a little background about yourself, your company, how long you've been in the industry.
Right, I've been in the industry nearly 40 years, but running CPC Finance with Julie for the last 21 years. And in that time, we've built up from basic mortgages right through to now investments, developments, and helping people build their portfolios.
Thank you for that. Now, when we started 2024, interest rates were predicted to fall quite a bit. We've had, I believe, 2.25% base rate cuts this year. So the interest rates at the end of 2024 aren't where we thought. Has that had an impact on business and on the way investors have been employing strategies?
It's been an up and down year because what was predicted didn't happen. There's been changes. So the main thing that controls it, which people need to be aware of, is the swap rates rather than the Bank of England. And what that means is the long-term predictions have gone up, then they've come back down again. So you see on a regular basis that mortgage products are changing constantly. We get emails one day that the rates are going up, then a week later they're coming down again. What that means is that you need to be aware that when you're offered a product, some people are saying, well, I'm going to wait. There is no guarantee that they're going to come down. At the moment, the predictions for 2025 is that there will be a gradual reduction, but something else could happen. Donald Trump could change all that in America, have a knock-on effect. There could be a war somewhere else that will have an effect. People need to, particularly in their business, if you've got products that are coming up for renewal, and mainly on buy-to-lets, is are they going to be able to get their money out that they would have? People that have done 5 years and then they normally look to remortgage again, take some more money out and buy other investment. There'll be a big jump in the interest rates from what they took 5 years ago. So it might not fit for a remortgage. It might only mean that they've got to do a product switch with the same lender and tie into a new rate. Or the other option, which we're seeing, is people getting rid of some of their single buy-to-let and then trying to move into the multi-unit, the HMO market.
Now, with a change of government after 14 years of a Conservative government, has that had an impact on where the market is and what we're predicting for 2025?
I think there was an initial period where people just didn't know which way it was going, but they brought out some things with the rents and so on. But what it seems to have done, in my view, is push rents up. Therefore, the demand is going up for the rooms even on a single property or in the multi-unit, which also means that in some way can push the yields of the property up on the commercial investment side. But it's still the unknown because these policies have still got to come through.
Sure. And the budget that we had in autumn of 2024, has that impacted where swap rates and base rate is?
Well, the initial shock was obviously the immediate increase in the stamp duty, which with no warning, no lead-in period or anything. So there was a 2-3 week period where that knocked a few purchases, more money had to be found, stuff like that. But I think now what everybody is on the investment side, they now build that into their costs of work and etc. up front. There was initially, the swap rates went up, but in the last probably 3 to 4 weeks, the 5-year swap rates have come down quite quickly. And that's why you're seeing some more, even on the residential homeowner side, a lot of rate reductions on a multiple number of lenders. So it looks good, but again, it can change overnight.
Were you surprised by the last Bank of England monetary meeting of 2024 that the rates actually stayed the same?
I wasn't that shocked. It would have been a nice Christmas present for people if it had come down, but that's not going to be. I think that they're taking the more controlled approach now than just dropping it for the sake, not the sake of dropping it, but 1 month in, month out. people can have a steady reduction in it, that if it's more controlled and then there's no knee-jerk reactions.
Now, with the mortgage applications that go through with CPC Finance, have you seen a shift to potentially more HMOs or multi-units or new builds, or what strategies are at the moment quite hot for you guys?
Well, throughout the year, we've seen a dramatic uptake on people wanting to do conversions into HMOs, commercial into residential conversions. Now, the main problem being is the demand and making sure that the figures stack up on their, one, buying it at the right price, and two, on the GDV. I think the commercial retail units, the prices of those are being pushed up because everybody's seeing what you can do with them. Maybe the advertising or marketing of it is too good.
Where have you seen the market with new builds now? New build blocks of flats?
It's still in demand, but again, is the price of the land being pushed up because of the demand for them? A number of people want to buy them and stuff like that. Everybody wants to do them, and the main problem that we see is people wanting to do them with lack of experience. Now, there's one thing converting a house, there's a second thing is converting a commercial to residential, and then there is ground up builds, is even more experience that the lenders are looking for.
Have you seen any lenders shying away from new build projects now?
They're not shying away. It's all about, they will only take on the right deal for them. And people need to be aware that it's not a market value you're doing, it's a residual val based on the GDV, working backwards, contingency, profit, all put into the calculations. And the day one land loan can be quite low, but that's so that the people that are doing it are putting a lot of cash into the deal.
Now, with 2025 on the horizon, where do you see interest rates at the end of 2025?
I would say I would look to expect it to be around the 4% mark if things remain the same. If something else happens, then it'll all go anyway. But I think there'll be a gradual reductions, maybe 1.25%, something like that, where it will be controlled down to a point. I can't see it going a lot lower than 4% within the next year to 18 months.
So potentially 3 cuts of 0.25.
Yeah, probably the first one being in January, February.
Now, obviously, Labour's announced that there's going to be doing some changing basically the planning system to allow it easier to build more homes. Mm-hmm. But obviously, we're now 6 months plus into a new government, but nothing's been announced. Do you expect that to be announced at the start of 2025?
If they get their way and it gets passed, then yes, you'll see it. But then again, it's going to push the prices up into an unknown area. You are going to get people that are in those areas that are going to complain. So it's not just a matter of saying, oh yeah, you can do it. There's a lot of things that you have to do, from like gaining the planning and stuff like that, and negotiating the price before you even start the project.
Now, we meet a lot of budding property investors, developers. One thing that they struggle to get their head around is finance, in particularly like buy-to-let loans, bridging loans, short-term loans, development finance. Is it something that you can break down easily for our listeners?
Yeah. Anybody going into conversion properties, i.e. house to HMO, commercial to resi, so on, they've got to use the bridging stroke heavy refurb products in the right way. They don't shy away from it. It's not expensive if it's done properly. It's the correct way of doing it. It's a stepping stone. It becomes part of your business, but people shouldn't be scared of it. If you know what you're doing and you do exactly what you say, it's a tool of the trade. People doing a buy-to-let mortgage, converting the property and so on, it's wrong. It's against the terms of the mortgage and it shouldn't be done. And you can get caught out. What happens if you do get caught out? Do you get blacklisted or slap on the wrist? Well, the mortgage can get called in. There could be a number of things that the action that the mortgage lenders take that could not blacklist you. Well, they could in effect blacklist you. You've committed a breach of terms. It will be shown as, and if they call the mortgage in and you can't pay it, then there's consequences of that. Sure. Now, when it comes to bridging, there's obviously you've got like a bridge, and you can have loan to values vary from 65 to 85%. And then I only learned when we started working together just over a decade ago that obviously you have refurb products that are out there with some specialist lenders. Mm-hmm. So can you maybe break down the difference and how they would vary in rates? Right, so you have a straight bridge, you have a light refurb, or you have a heavy refurb, then you have development. They're the 4 stages. A straight bridge is exactly what it is. It's against the purchase price or the value of the property, and you have to fund all the work yourself. So you pay your deposit, and which will normally be between 15 and 25%. You have to fund the work. Then you go on to light refurb, which again is very similar, but it will be probably a higher loan to value, 85%. All of these are subject to the valuation confirming the appropriate GDV. When you get into the heavy refurb, where cost of works is say over £50,000, they'll fund towards the purchase and they'll fund the works, but the works are funded in arrears. So there's more control of the lenders on the project, i.e. they'll involve an asset manager or quantity surveyor, so it's an additional cost. You have to get a percentage of the work done to get your money back and then go again. So it's a more hands-on approach from the lender. They do work, and they do work very well. All lenders have got different loan to values, different rates. A lot of it is based on experience, and as and when you work with the same lender, they learn your product, i.e. how you finish your deals, then they're keener to work with you and they make more allowances.
Now, one of the questions that we get asked on socials is, how do we value up a HMO or a commercial residential deal? And obviously the end value varies depending on the type of valuation you go for, and also the lender. So can you give us a bit of an insight into that?
Well, yeah, the end value that you're looking for, particularly the main area being the HMO, there's two types of valuation. There's a bricks and mortar, and there's a commercial yield based valuation. Now the difference is the bricks and mortar 9 out of 10 times will be lower, and therefore the rate from the lender will be lower because they're lending against just the value of the asset in bricks and mortar value, i.e. like next door. So, but there is no uplift for running as I call it, the business side of it. On a HMO investment, it's more like a business value because it's based on the rent that the asset is producing. So there's an element of the bricks and mortar within it, and there's an element of a trading business in it, which a HMO is a trading business. It's producing, you have to manage it on a monthly basis, you get an income in, and you have costs that go out, and it should be profitable, which is quite a big thing. And it will be based on the yields in the area. We've done a lot of work, which you might have seen recently, on all the valuations that we've collated, which give us an idea of what yields are in certain areas, and it does vary. One of the big things to take into account, which nobody will be able to tell you till the valuer sees it, is valuers deduct management costs from running the business. Now that can vary between 8% or up, and we've, in certain circumstances, on large HMOs, we've seen 35%. We take that off the gross rent, it drops the figure that they calculate the net yield by quite a lot of money. So you can get quite a variance in different valuers having different opinions on how much it costs to run a HMO.
And does this now vary when we're looking at commercial and residential deals?
It does. You've got different yields for commercial to HMOs. A commercial unit will normally produce a lower yield, which then is a higher value than what a residential part will do. As an example, normally some commercials are coming in with a 6% yield, whereas the residential side might come in at an 8 or 9 or 10% yield. So the actual value is split into two parts. The way that I know with your project, there's more of a residential element than the commercial element on the end. So you have to mix up the two calculations.
No, you're right there. When it comes down to bridging, I've seen there's so many new entrants into the market. Whose responsibility is to pick the ideal bridging loan for the client?
If you're going through a broker, the broker will discuss what you're trying to do, what amount of funds that you've got. On bridging, the more cash that you put into the deal, the lower the rate's going to be, because lower the loan to value, less risk. But also there's criteria that the endless number of lenders have got. They've all got their own caveats, they've all got their own criteria, so there is no like for like. Some accept online valuations, some insist on the full valuation, some will do a bricks and mortar, some will do a yield. So again, it's about finding what you are trying to achieve, and we will then find out what product best suits what you're trying to achieve. It might not be ideal, it might not be the perfect answer. It might be a way of structuring the deal, which we're finding a lot more at the moment, is where your money's coming from for the deposit. Are you using additional equity out of your portfolio? Is there investment loan, an investor's loan in the background? Is it your own funds, etc., family gifts? So again, some lenders will some versions of that. Some don't take additional security. Some don't like investor loans. So it's knowing the full picture. I think I referred to it previously. What a broker does is like build a jigsaw. We have to have different parts. We get it all together, and when the jigsaw's finished, we know where it's going. And that's how a broker works. So it should streamline it for the individual.
I know we've discussed when you go with certain lenders, if you go even one day over the term, you could be hit by penalties.
That's in the small print, which will be explained to you by your broker, and you should always get the documents checked or go for advice, at least, even if you're going direct to a lender. Some lenders don't charge for overruns, but as long as you're in contact with the lender and you're making them aware, it might be that you've had the delayed sale, it might be you've been delayed by your builders because of the weather, or etc. Keep in contact with your broker and your lender, and they will work with you. There are lenders that within the contract that if the day you overrun it, you're charged a rollover fee, and that can vary. It could be 1%, it could be 5%, but that's all in the documents that you sign. So you need to be aware of what you're doing. Sometimes there's also reduction in rates. They'll say the rate is 2%, but we'll give you a 1% reduction, so it's 1% a month. Again, it's all in the small print. Now, do you want that risk hanging over you that if you do something wrong, the monthly payment's going to double, because that comes out your profit of the project?
Yeah.
So again, the small print is important.
And am I correct that the solicitor will also, if you're doing a purchase, the solicitor will put a report together, and the report will also include details of the loan?
It should do. The solicitors they'll do a report on title to the lender, but they'll do a report on title to yourself, which will summarise the terms and conditions of the offer, and also the background of the property, if it's got any history, what you're lending against. And then most importantly, what they'll also do is give you the bill for what you've got to pay.
Now in 2025, how important is it going to be about your exit strategy? So by this I mean, I meet investors and say, well, I'm going to buy this and I'm going to convert it into 2-3 flats. These will sell. Would a lender look at, okay, that's one of your exit strategies. What if they don't sell? What is it going to be on holding it?
Yeah.
And if there's a shortfall, because it's going to be like an investment value, like rental calcs and so on, do you then need a buffer just in case you have to?
Lenders always want to know the exit, and they always want to know a plan B on the bridge. Prime example of that is if you're going in with something that needs planning, you'll only be getting a straight bridge until the planning's granted. They will want to know, well, what if planning's declined? What is your exit? Well, because once planning's declined and you go to sell it, investors aren't going to buy it because planning's already been declined. So then what's your out? And that's why normally something like that, you'll find a lower loan to value, because there will be an exit based on possibly a forced sale. With the others, that they will want to know, like, even if you say it's going to be a sale, obviously they'll work on the individual GDV values and they'll want part payment down on every sale that's done. And then they'll want to know if you don't sell them all, what you're going to do. Now, if you're going to go into a term facility, they'll want to see an agreement in principle, knowing that there's a lender out there that's going to lend to you on that route. Sometimes in those scenarios, it's better to go with a bridging company that does term facilities as well,
sure,
because they'll take it on and they'll lend knowing it fits their criteria day one. Something like that gives you the comfort that you've got an exit.
This year, have you seen a lot of people that have been unable to exit, and all companies they've been working with that fell into difficulties?
Fortunately, not that many. I've heard of some, not that we've dealt with them, but people have contacted us and said, I've got a bridge that I can't get out of, can you help? Well, we'll do what we can, but sometimes it's too far down the line, or it hasn't gone to plan, so that their end value isn't what they were expected. And that's why it's quite important that if you're relying on a day one valuation done by one valuer, you might jump ship to another lender, but if you've got to use a new valuer, it might not come back at the same figures. So as long as you're happy with that day one figure, try and use a lender that uses that valuer, because you've got the history of the property.
Yeah.
If you go out to a new valuer that's only seeing the finished article, he might not be aware of the whole project, and therefore he hasn't got the background on it. It gives you a different figure, you don't get your exit.
Now, when it comes down to bridging loans, I experienced this myself. I had to sign a personal guarantee. It was quite daunting at the time. Obviously now we're used to it. But can you sum up what a personal guarantee is?
Yeah, if you're doing a loan or mortgage in your personal name, you sign for a mortgage. When you go into a limited company, they lend to the limited company, but ultimately they're lending to the shareholders. It's the shareholders they do their background on, their credit, their experience, their background. The way that it works, you can shut a company. Now, you could shut a company down and walk away from the debt, wash your hands. That's why it's called a limited company. But the lender want their money. And they've lent to you, so they'll ask you for a personal guarantee. And therefore, what you're guaranteeing is that they get their money back. If the project goes wrong or something happens and they have to take possession of that property and they sell it, and they will sell it on the open market, they don't just give it away. They will try every avenue to get the best price. Ultimately, the last resort would be they'll put it in auction. If they don't achieve the exit to pay off all of their debt, say you owe them 200,000, they get 150, there's a 50,000 shortfall. They can come after you because you signed a personal guarantee that you owe them £50,000 and you have to find it out of the rest of your assets. They can call it all in.
Okay. Now, I've also seen online a lot of people using SAS pensions to invest in commercial properties. Mm-hmm. Have you had experience with clients doing this?
Yeah, and it's not a regular thing. Now, with SAS and SIPs and all sort of pension lending, the thing that controls that is the terms and conditions of the pension. There are limitations on what you can and can't do. So it's fine, and basically the rent goes into your pension. I believe it's tax-free, so it builds your pension up. But there are terms and conditions of what it can lend on, what type of property it can be. Some situations it can only be on commercial, some it can only be residential, and it could only be up to a maximum of 50% of the value of the asset. So you still have to put other money in. So there are all different things that can be done. It's just a different lending entity as far as I'm concerned, but there are within the terms and conditions of the pension what you can borrow against. Now, one of the other things to consider is not a lot of lenders do it or do the pensions, and the ones that do have a minimum loan amount. So again, there's a lot of things that got to come together to lend to a pension.
And with say, for example, if you're buying a commercial property, can you do a commercial to residential conversion under a SAS?
Again, going back to the terms of the mortgage, the ones that I've seen or have been involved in have been only on the term facilities. I've not done a bridge in a pension because, again, it's outside of the terms.
Yeah.
That they're lending to return on income. Now, if it's on a bridge, they're not getting the return on income, and therefore it's outside the scope of the pension lending.
Yeah, I know you're right. Well, we hope you actually found that insightful. Look, we're going to be back again with Carl, I'm sure, in the first quarter of 2025 to go discuss where we are and opportunities that potentially in the market. Now, Carl, if someone wants to get hold of you, what's the best way?
All our normal social media outlets are out there, or they can contact me directly at CPC Finance. My email address, kg@cpcfinance.co.uk.
We've got a free community. We've hit over 1,100 subscribers. So we've got property investors, developers, architects on this platform. It's completely free. Join it. The details are in the description below. Now, if you've enjoyed this video, hit that subscribe bell icon, and we hope to see you back each and every week with new videos.